some new healthcare updates regarding the Cadillac tax. It's becoming a bigger and bigger piece of what employers are starting to prepare for, even though it's so far down the road as far as 2018. Kind of seems silly to think back, but when the law came into place in 2010, how far we've come so far. This is a very, very large funding vehicle for all the subsidies that are going on. And there is some things going on at the federal level with the Supreme Court regarding subsidies. But depending upon how the states are set up, and in the state of Washington where state exchanges do exist versus Oregon where they don't right now, we would anticipate still seeing this if it's still in play in 2018. So a lot of large employers are preparing their benefits departments to plan for this and how they're structuring their benefits packages over the next couple of years. And we'll show you some examples of really what that looks like in just a little bit here. My name is Tyson Fuhr. I'm the Compliance Division Manager for Biggs Insurance Services. My contact information here is up on the screen with my email address. Should you have any questions through the presentation, there's a little chat log on the right side of your control panel, which you might have minimized already, that little red arrow. Go ahead and ask questions along the way. We'll try to answer them if we can. We anticipate this presentation probably lasting 20 minutes or so, maybe up to 30, depending upon the number of questions. We will send out the copy of the slides, so you have those after we're all done. And if we're not able to answer any of your questions or the actual question you might have on this presentation, we will get an answer to you via email at the end. So we're going to go ahead and get started. So today's agenda is really about current perspectives and then really going into 2018, the benefits planning, because this is really what the Cadillac tax is really at right now. You might have been in the position of having to deal with pay or play modeling and some of those decision-making items and all the delays that happen with that. We wouldn't anticipate the Cadillac tax to be delayed just because it does need to come into place just to start offsetting some of the subsidies that have happened. So current perspectives. Just a couple basics about the Cadillac tax. It really doesn't hit until your taxable year of 2018. And so what does that really mean to an employer? You're not paying this thing until 2019, just like we're dealing with now. The 1095-C reporting for groups of 50 or more employees, where it's a 2015 tax year but released in the 2016 January reporting cycle. So what it does, though, is that it imposes a 40% excise tax on all high-cost group health coverage, and also known again as the Cadillac tax. High-cost health coverage, at some point, a lot of people thought that this was a union-only thing or a school district or municipality-only thing. When the stats keep on coming in, what we're starting to see is that it's hitting anywhere between 40 to 60% of all group plans, meaning that companies all the way down to 2 are going to be hit with this. So the tax is intended, though, to encourage companies to choose lower-cost health plan for their employees. So the government essentially is trying to dictate what an employer is able to offer, and if they're offering any more than that, then they're going to pay a pretty significant penalty. Okay. So coverage is subject to the Cadillac tax because, again, it's not just about the medical insurance, even though you can see that there. Fully insured medical and self-insured medical are part of the Cadillac tax. Government plans, when you're looking at HRA, health reimbursement arrangement, HRA is also has a term regarding wellness plans, but HRAs with regard to the medical plan and them being integrated and paying claims, those claims are actually considered inside of the Cadillac tax. FSA contributions for the employee and the employer are considered inside the Cadillac tax. HSA contributions for the employee and the employer. And then they have this little caveat there for self-employed individual plans insured under the group plan. So this might be key executive plans, and those might start getting put into place as well. But there are a number of plans out there right now that are accepted as not being part of the Cadillac tax, and those would be your dental and vision plans, accident or disability type plans, supplemental plans like your AFLACs, those kind of things. Some employers are providing automobile policies, and workers' comp obviously would not be. See a couple of the other things regarding credit-only, automobile medical payment insurance, and some of these others that are secondary and outside the group medical plan. So basically, the biggest thing about the Cadillac tax is that anything that has to do with the health plan itself, the group medical plan, is going to be included in assessing whether there's an excise tax to the employer. Okay. Annual limitation. So there's an annual limitation on all of those items that are being taxed that any dollar amount above is when you start seeing that excise tax. And so what that dollar amount is today is $10,200 for individual coverage and $27,500 for other than individual coverage. So as a rule is set up today, it means that anything that is employee plus, say, spouse or child or children or family falls underneath the $27,500 cap. So group medical insurance premiums, let's say you have an HSA contribution, those two things for the individual can't be more than $10,200 or over $27,500. Anything above, and it's not a 40% tax on the whole thing, but anything above the $10,200 limit is something that the employer has to start considering as something to avoid if they can. There are some risk pool relief out there, so the government really realized that there are certain professions that see higher than regular conditions for their premiums, and so then they allowed a individual increase and a other than individual increase, and you can see that number there, $11,850 for individuals that fall in these high risk pools and $30,950 for other than individual risk pools. These numbers are indexed, so you can see them change, and that's one of the biggest things that some people are hoping will change because the numbers were established way back in 2010 and projected forward, and so you might see these things indexed up just like you have seen on the FSA limit going up just a little bit. But the high-risk pools are folks in qualified retiree programs and some of these other high-risk professions, law enforcement officers, fire protection, so your fire departments, individuals in some emergency care. So you can kind of see how the unions got involved a little bit there in trying to minimize some of their expenses or try to get some more bandwidth. Construction, mining, agriculture, forestry, and fishing industries, longshoremen, so again, back to the union kind of thing, and then some other high-risk professions too. So interestingly is that when the Cadillac came out, a lot of people were saying this is a union tax. Well, the unions were really the only ones to negotiate the level up a little bit. Okay, so that's kind of interesting from my perspective at least. But statistically showing is that all group plans right now, if the limits stay the same, are going to be hit. About 40 to 60% of those are going to be hit with the Cadillac tax. And this is one thing that is going to be a little bit of a challenge, even though it makes sense logically, is that the employer is actually the one that's responsible for calculating the Cadillac tax that's owed for each employee's sponsored coverage. Why does the employer need to do that? Well, if you left it up to the insurance company, for example, if you had a medical insurance company doing all the reporting, they're not going to know about necessarily the health reimbursement arrangement or the FSA contributions or the HSA contributions or some of these other things that might be added into the plan. So it's leaving it up to the employer on actually doing the reporting part back to the provider and to the IRS at the end of the day. So as you'd imagine, there's probably going to be some new IRS forms that are going to be put together to be able to report this information. The forms that already exist for paying the tax as well. But this could possibly come into play and become a little bit of a challenge. Okay. So aggregating the cost of the tax. The aggregate cost of employees' applicable employer-sponsored coverage is the sum of the cost for each coverage. And so we wanted to pull out two specific items because FSAs and HSAs are probably the two biggest things that are going to come into play on this, where the employer might start changing the limitations on maybe the FSA contribution or what they contribute in to the HSA. So I wanted to read this out real quick to you. So on the left-hand side, you have health FSA. So the cost of the health FSA coverage is the sum of the employer's salary reduction contributions plus the cost of any reimbursement in excess of the employee salary reduction contributions. So as you can recall, in the case of an FSA, an employee has all the money available to them of what they elect. And so what this is meaning is that even though you may have not pulled out the salary reduction contribution, whatever is being elected and paid and above the amount that the salary that's been contributed so far is actually going to be considered inside of the employee's total amount that might be imposed on the Cadillac tax. And then you see on the other side you got HSA. So the cost of the HSA or Archer MSA. You don't really see Archer MSAs anymore. But coverage of the amount of the employer's contributions. If the employees make salary reduction contributions to an HSA through the employer's cafeteria plan, those contributions to be considered employer contributions and counted towards the cost of the HSA coverage. So what you may see then is that you might see employers disqualifying the HSA contribution as a pre-tax contribution because the employee, if they're making post-tax contributions, are actually able to get a dollar-for-dollar deduction on their taxes. And so you'd probably see that being the adjustment inside the HSA options that are coming up to play. Okay, hopefully that makes sense. I might have gone over that kind of quickly, but when the employer is trying to put the calculations together, these are really some of the key items that they're going to have to start putting in place, because these are probably calculations that don't exist today. Underreporting the tax. If an employer or plan sponsor fails to accurately calculate the excess benefit to each coverage provider, so again, remember, this is the employer reporting it to the insurance company and also the IRS. The employer or the plan sponsor will be subject to the tax penalty. The coverage provider will not be assessed any penalty, meaning that the insurance carrier, if you underreport to the insurance carrier the amount of the penalty, then they're not going to be assessed the penalty, but the employer would be. And what that penalty amount is 100% of the additional excise tax is due and interest on the underpayment. So the IRS doesn't necessarily work super diligently, and so they may catch up to you 3 years down the road, and they would apply an interest for that underpayment on top of your tax. Okay. Now, right now there is today a lot of interest inside the Cadillac tax because of the potential cost to the employers, and so some of the regulations haven't been fully put together, and so you can see here that the IRS is actually taking a public opinion, or what they call public opinion, on these 1, 2, 3, 4, 5, 6 items: definition of applicable coverage, determination period, applicable dollar amount, applicable employer-sponsored coverage, determining the cost of applicable coverage for the HRA and the self-insured plans, and then dollar limit adjustment. So one of the things that comes up, and a lot of this other stuff is going to be played out by the IRS itself, but you can see here, because there's some people on the call today that have self-insured plans, you would have to have an equivalent plan premium, because in the case of self-insured, depending upon how your aggregator, your specific deductibles are set up, you may or may not have a premium equivalent. So a lot like how the COBRA premium equivalents are created, you would have to then again do that for your self-insured plan as well. HRA premiums. So HRAs are COBRA eligible as well, and so there is actually a technical way of creating a COBRA premium equivalent. So if an employer was to continue offering that type of coverage option on the claim side of things, they would need to create an actual premium. And so actuaries are out there to do this, because generally speaking, most employers are using a pretty inaccurate number when they're putting this together. In the state of Washington, where we're going to see small group turn into employers under 100, one of the biggest challenges that you're going to see is in the near future, in 2016, is the age bandit issue, meaning that an employer, if you're a 50-plus employer right now, you may not know this, but with a 50-plus employer or underemployer right now, you're actually paying a different premium for each individual employee and their spouse, and then up to 3 kids. And if they have adult dependents, and you're paying premiums for them too. Well, your older populations are going to have a much more expensive premium than your younger populations do. So you would actually have to pay a tax on maybe those older populations, whereas you wouldn't on your younger populations if they're underneath the Cadillac tax number. So you're making calculations down to the employee level if you're a group under 100 in the case of the state of Washington. Oregon, you still have the 4-tiered structures. If you're a self-insured plan under 100, you might go to a 4-tiered structure, so that might make administrative reporting a lot simpler. And so you might see that becoming another reason why employers are getting a little more serious about looking at self-insured plans nowadays and in the future. This right here shows an example or a calculation for an employer. In 2015, with employee-only premiums around $475 a month, and family premiums about $1,400 a month. Annualized in the top, you can see is about a $5,700 annualized cost for the employee and $17,000 annualized cost for the family coverage. If you project that out over over the next couple of years through 2018, so that now you've got a 12% renewal increase year over year. You can see in the very bottom, 2018, this employer is fine as far as their costs. So they're under the number, and then you continue to project out those 12% increases, so they really wouldn't have to pay the tax on the employee-only coverage until 2022. Okay. However, on their family coverage, in 2020, they're going to start getting hit from that side of things. Okay. So now what are employers doing? Well, employers, what they're doing now is that they're starting to look at projecting this coverage out over the next couple of years, and what they're going to have to do to start minimizing these numbers. When the actuaries get involved, and then actually the government gets involved in looking at how they're going to be able to see this tax coming into play, they actually project this number in about 2034, where just about every employer out there is going to pay the tax, assuming that none of the changes happen to that limit number. You'd expect them to change. However, at the same time, you also realize that the healthcare system is going to be supported severely by this Cadillac tax from the employer perspective. So what do we expect to see? Employers are going to circle back on the pay-or-play modeling to see, does it really make sense to continue offering coverage? Because again, groups under 50 or don't have any taxes or penalties if they're offering coverage or not. And then groups above 50 are going to look at it and really start having to calculate what's the benefit to our culture by offering this coverage versus what the overall cost is, and what plan options are we going to have to look at going into. This is an employer here that's seen a pretty significantly higher number of premiums in 2015, and actually this is a real-life case, just so you know that these premiums do exist right now, where employee-only coverage sometimes is $800. You project that over, and you can see they've got a pretty ugly renewal increase at almost 24%. They're going to be hit by the tax in 2018 for sure, significantly hit by that tax. And so they're starting to look at some options specific to them and how they can start changing plan design options, so you can start looking at how you help the employees out from that perspective. Because the challenge is, if you run all the way into 2018 and make a major change to the health plan, what's that do to your culture as well? And so obviously offering health coverage to employees, you're doing it for a reason versus just having to write an extra check. And so employers are really starting to get really tactical about how they do their plan designing. Looks like we're about 20 minutes into this, and so I'm going to pause just for a second to see if any questions come up. Again, remember on the bottom right there's a chat log for you. So if you have any questions right now off the top of your head, go ahead and plug those in, and we'll go ahead and get to them. If, in fact, that you think of questions down the road, I'm going to pop up my contact information here for that. One of the questions that came in, and we'll just reiterate, this is about the age banded. So in the age banded system, you're going to have employee coverage, maybe one employee, because they're younger, it might be $300, whereas you have an older employee that they're at $800. Okay, any number, when you project out that $800, I'm going to back up here for a second. So let's say that older employee is employee-only premium is $870 a month. You project that out, their annualized cost is going to be above that $10,200. Okay, so what does that mean? So for that one individual, you're going to pay a 40% tax of anything above $10,200, and this doesn't include their FSA contributions or HSA contributions either, which would have to be considered in there as well. And so you can't really set up an age-based limit, but it is something to consider overall for the health plan. Another question regarding the Cadillac tax, is it applicable to employers under 50? The Cadillac tax is applicable to all companies above, that have a group plan, so 2 or more. But what doesn't exist is if you're not offering coverage at all as an employer, there's no penalties if you're under 50 for not offering coverage. And so if you're not offering coverage, then there's no Cadillac tax to assess. Okay. All right. So we're going to actually wrap up our presentation today. If you have any questions that come to mind in the future, here's my email address. Feel free to reach out to me or make a phone call in if you want to talk about something specific about your company. And I really do appreciate your time this afternoon, and hope you have a great day.